Singapore's central bank is expected to stand pat at its upcoming policy meeting. That's according to at least 10 financial houses, with the majority attributing it to a gradual recovery in the economy and inflation still in line with expectations. The Monetary Authority of Singapore had eased its monetary policy at its last meeting in March to support the economy. Brandon Tanoto with more.
According to economists, fiscal measures like the job support scheme will still be the heavy lifter if more economic stimulus is needed during the pandemic. That's because using monetary policy as a tool to spur growth creates a less targeted outcome. While it makes Singapore's exports cheaper to global buyers, which is an upside for the trade-reliant and open economy, such a move doesn't provide much relief to sectors that aren't export-oriented, like transport and hospitality.
Our exchange rate policy is more medium-term. It is actually quite a blunt tool because you do not know what will be the actual specific desired outcome, because you can't specifically target any particular sector or any segments in the society. That's the limitations of monetary policy.
There won't be an immediate impact on the daily lives of Singaporeans if MAS leaves policy unchanged, but consumers could gradually see prices for goods and services come down due to weak consumer spending and a slack labour market.
We still expect inflation to stay negative for the rest of the year till 4Q, but the pace of decline will likely be softer than what we saw during the second and third quarters. Job losses and wage cuts will likely cap any domestic price pressures.
Still, economists say it's premature to completely rule out another easing, adding that even if MAS holds back on easing this time, it could still happen at the subsequent review next year if the slack in the labour market lingers. The expiration of support schemes could also influence the performance of the economy in the coming year if demand does not recover. Now, Singapore's economic growth is expected to come in at between -5% and -7% this year, after it posted its worst quarterly performance in the second quarter. Now, this outlook is worse than the previous forecast range of between -4% and -7%.